Gold is having its worst day in about 12 years, and we're going to talk about it during office hours with Professor Mark Guthner today on Open Interest. Hello, everybody, and welcome. I'm really just not that good with that bell, am I? Hello, everybody. Welcome. I'm Mike Coe. Welcome to Professor Mark Guthner, as always, for office hours. And, Mark, I think you just published an idea, was it within the last couple of days on the Options Edge website, suggesting that maybe people take their profits on the long gold trade that you had recommended some time ago. Is that right?
Yeah, it's nice to get one right every now and again. So, for those that are our followers and readers, the real point was that gold had a big run, but it was the nature of the run that the price pattern was showing an exponential rise on a log chart. So that means that the price action is accelerating as the share price goes higher. And that's typically a sign of too much enthusiasm. And so probably time to take your profits. And, I always liked when I trade, leave a little money on the table for the next guy. And so I guess if they bought it and sold it yesterday, then they're okay. But yeah, today's pretty harsh. That sell-off is kind of brutal. And then there's something else that I was thinking about that we were talking about just before we came on air, was that the debasement trade has a name. And so we kind of named what people were doing with gold. And that typically happens after a move has gone for an extended period of time, when something becomes so fashionable that you give it a name. And so that made me a little nervous from a psychology and a kind of standpoint, market psychology kind of standpoint.
Yeah, I mean, I have it up on my screen right now. This is actually the 30-day chart. We can get a sense of what was going on here. I'll admit that I probably, what I had sort of been looking for was, that day when we gapped higher off the open to new all-time highs and then reversed, just from my old floor days. That was kind of that downside reversal that, put a good scare into all of us. I would also, add that, kind of to your point, and why don't we actually just take a look at this? We'll just extend this chart a little bit and look at just how pronounced this run has been. So, we can see that this most recent move has been quite pronounced. And you had mentioned a log chart, so why don't we put that in as well and extend that even further still. And why don't we just go to, actually, this
go
is
back
the
about
futures.
10 years or so.
Yeah, you know what I'm going to do? This is the futures, so to do that, I actually have to look at spot.
Okay.
So we'll do
XAU currency.
We'll do a 10-year spot graph. So we'll go back to 2015, and that looks a bit like this. I'm going to put, just because I think one moving average is enough.
Yeah.
We'll go like this. And so you can get a sense of just how pronounced this is on a log basis, how pronounced this move has been of late.
Yeah.
And also just how far above the long-term moving average it had gotten. It has gotten well above the long-term moving average on a couple other occasions. It did so over here, as we can see where that little block is. You can't see my cursor, but you can see where I'm hovering. It did so over here, where that block is.
Mm-hmm.
It did so over here.
And then it just accelerated.
Here, and then there, and now here. And in almost all of these cases, it didn't mean that the long-term bull market was over, but it did suggest that maybe things were getting a bit frothy. And I think that's kind of what has happened here. Where would you turn buyer again, do you think? Because
the easy one
I
is
think you just
the easy one's all the way down at 2000. More difficult, but the more difficult trade might be around that 3200, 3300 kind of way, that last little congestion zone in 2025. If this is just going to be a small dip, you know,
you don't think it's going to bounce off the long-term trend line? I mean, that's typically been a pretty good entry point.
It could, yeah. It could. So you got the 150. Carter likes the 150.
Yeah, this is a 150. I'll put a 200. A lot of people look at the 200. That's around 3,300. Yeah. And you can see that if we use this as a long-term guide, if you had bought it at that level, the pain that you'd have taken for having done so would have not been that great. Mm-hmm. You would have, it would have been a good entry point here. Not terrific here. Then it was basically sideways, but again, your downside risk was minimal. The only issue is that this speaks, by the way, to just how far above trend this thing is, and that is that long-term trend line. Oops, and I did not do that correctly. But that long-term trend line. Let's just use. I like to use simple round numbers, so we'll just use 3,300. It's actually slightly lower than that. Use 3,300 and 4,140. So that's down 20% from here.
Yeah, that wouldn't be surprising. You know, what often happens when something starts to relentlessly rise, speculators like to take on some leverage. And so they might borrow some money, or they might use and double up on things like GLD. Or they might look to the futures market, where you need to only put down 5 or 10% to own a futures contract. That's another way to do it. And of course, we've got these levered ETFs now, and people can jump on that. So when you start to throw caution to the wind, that's when the
5%. 5% is what you need. For the
futures?
For the COMEX gold futures. It's interesting, too, because, you mentioned it. I'd sort of said that it felt frothy on a couple of occasions. I mean, you obviously wrote that piece. Carter Worth last week, and actually I think the week prior had first signaled that people might want to start selling some calls, and then I think he actually just said pull the ripcord on it last Wednesday or so. Now, granted, it did actually hit new highs since that time. He was just making the point that the price action was getting to a level where he was saying maybe it makes some sense to reduce your longs. And actually, let's take a look at that.
Picking a top or a bottom has more to do with luck than skill. Especially, when we're in one of these kind of frothy moves, because we know that it can go a lot higher. I mean, GameStop was the perfect example of people saying at $40 that's as high as it's going, only to see it go to 60, and then they say 60 is as high as it could possibly go. And then it goes to 80, and then it goes there's no way it's going any higher, and then it goes to 100, and then it's just like the world's gone mad, and then it goes to 120. And it's because there's new short sellers that keep coming in at higher and higher prices. And if the squeeze is on, they just take turns of getting squeezed out.
So this is the Commitment of Traders report right here. Probably a little bit hard from the CFTC for anybody who's ever interested in kind of tracking this sort of stuff. You can go to the cftc.gov. Actually, if you just Google it and say Commitment of Traders report, futures, you'll get this, and it'll show you essentially what the changes are in these positions over the course of time. So as you can see, people were getting longer and longer. If we were tracking this if we had a time series, and maybe I can get that off of Bloomberg, that would be a little bit better. But I guess the short version is your take is that now is probably not the time to initiate. Even though we're down pretty precipitously today, you're not suggesting that this is the time to re-enter your longs just yet.
No, let it play out. There's some people that are gonna come home from work and go like, "What?" You know, when they see what the market did, and then they'll have some hard decisions to make on Wednesday and Thursday, and so there could easily be some follow through here. But I'm not ready to jump back in. I would probably be tempted if I was an active trader, speculative trader. I would be looking at that 3,200, 3,400 layer area that that I just mentioned.
Mm-hmm.
There's another great place to go to get a commitment of traders. Barcharts.com has produces nice charts. We've got a link to it on the front page of our website, the Options Edge, just labeled commitment of traders, and it shows how the positions change of people, the different types of traders, whether they're small traders, commercials, or speculators. Um, and you can kind of see how those folks are kind of moving in and out. Commodities tend to be
This, by
dominated.
the way, this is the gold commitment. This is a time series
Yeah,
right here, long contracts and futures. So it's not. I mean, it's not as high as it has been.
yeah,
Um,
yeah. It's a little,
but certainly there's some rapid growth lately.
yeah. It's kind of surprised that open interest wasn't moving towards all-time highs. That tells me that the odds are there's going to be a flush here, and then we'll probably go to new all-time highs in several months' time, maybe 2, 3, 4 months into the future after there's this shakeout. Markets do that to you all the time. That if that it wants to remove the greedy from the playing field, and so I recommend to folks all the time, and I talk to my students who are investing is don't use leverage. If you're getting in, you're especially in volatile instruments. Now, gold is not particularly volatile, but I have students that love to trade crypto with margin, and you're already working with a 50 to 100 vol asset, and because depending upon the crypto they like to trade. But I've got some that really like to whip and drive them, and I said, well, if you're going to do it without leverage, and be happy with 20% moves. You don't need to make 100% in a week.
So one of the things that has certainly underperformed, and actually Tim Seymour made reference to this on Fast Money yesterday, as we were talking about gold, we were talking about the miners, and then
Yeah.
we started talking about copper, and he was talking about Freeport, and you were mentioning that he was actually sort of making a comment about industrial metals in
Yeah.
general. Copper is lagging gold quite considerably here. Um, it's only off 1% today. So even as silver and gold were both getting really tagged,
Yeah.
they're off their intraday lows at this point.
Yeah.
What are your thoughts on this? Because copper's rather important for the data center trade, isn't it?
Yeah,
For AI,
it's an AI
among
trade,
other things.
and it's a little surprising it hasn't done better. Um, the price of copper relative to gold is around an all-time low at levels it often hits. Is there a way for you to make a chart of copper divided by the price of gold?
There's one right there, right? It looks there's a oh, that's sentiment. Let's take a look. Let's see what chart we have there. Um, that's the copper. Oops, I think we just had the copper gold ratio. Not sure what
Okay.
happened to that.
I
Um,
don't I don't know I don't know what you're looking.
yeah, yeah. No, I was just saying that Yeah. You had sent the sentiment chart, and that's what we had up there. So I can build one. We give me a second. I'll put that together. We don't need to put my spreadsheet work on the sheets there, but let's just take a look. I want to make sure so I can look at it on let's see, spot copper is what I need here, which is XC. There we are. Okay, so I will certainly take a look at that. In the meantime, XCU currency. Oh, and I also should probably just take a quick peek and see whether we're getting some questions about this. This is, I mean, I don't know about super crowded trade, but people are in it. And I don't know. FinWest, hey guys, we reached a high in gold when a vending machine was installed in my local shopping mall in Bangkok for buying gold and silver. That is great. Remember that when, one of the earlier in the crypto craze, they were talking about doing that, creating vending machines where people could go and buy Bitcoin. So, yeah, I think to Mark's point, when a market trend gets a name, when a trade gets a name, that's a sign. At a broader economic level or for a given company, there's the tall building indicator, right? So whenever a city is going to build the tallest skyscraper in the world, or a company wants to build the tallest skyscraper in the world, you kind of feel like, okay, they've lost the plot. They're focusing on things they shouldn't be focusing on, and enthusiasm is arguably at kind of frenzy-like levels.
If I can share my screen, Mike, I got a quick chart I just slapped together.
Yeah,
goes back to 1990.
Let me make sure. I'm going to hit the stop share, and you can share yours. That should work.
The one I can. Is that the one I can do? All right. So this is I'm using stock charts. Oh, okay.
Yeah. Okay. So producer Jay is going to get that.
To share my screen
for us. Mm-hmm. Let's see. This is the copper, and you're getting that from stock charts, or you could post a link to me, and I can.
I can do that. Let's see. Up. I'll just drop that into Slack. I don't know. You might have to rebuild it.
Oh, okay. Well, we'll keep that up, and then we'll see what's going on. Let's see here, and we have another comment here. My hypothesis for gold is that other countries are trading goods with gold instead of the dollar. Thus, demand goes higher. Is my hypothesis correct, and does it reflect the correct price? So, I don't think we're quite at the stage now where gold has replaced the dollar as the default medium of exchange in other countries just yet. There's a lot of things that gold has going for it. First of all, as a hard currency, obviously its history is unmatched. So it has that. But it is not particularly convenient for effecting transactions electronically. So I think it's unlikely to do that. Oh, let's see here. So okay. Oh, there you go, Mark. So your screen is now live.
Oh,
so
okay.
We can.
So I just took this, and I took the spot price of copper divided by this spot price of gold, and you can see that. Well, I can only go back to 1990, but going back that far, essentially we are as low as it's ever been in that 35-year period. So that's pretty. That's telling you one of two things: either copper is way too cheap or gold is way too expensive. I'm not sure which is which. Um, it's one of these things where you think, oh, commodities are a nice inflation hedge, but here's where all the money is just flowing into one commodity, that's gold, and it's ignoring the price um, of a
Yeah.
copper. Here's another one here. I'll just see if I can make it really take West Texas Intermediate. I think it's WTIC. Oops, I got to go. I need a dollar sign.
Mm-hmm.
I need a dollar sign in there because we get the same story if we're looking at the price of oil. Look, this is price of oil divided by the price of gold. We're kind of way
Mm-hmm.
down here at much lower levels than we've historically been. Again, so does this mean gold is too high, or does it mean oil is too low? I'm sure you in California don't want to see any higher gasoline
Oh my
prices.
goodness. Yeah, I mean our problem isn't the price of crude. I mean crude is in the 50s.
Yeah,
Our problem here is
taxes.
that well, it's taxes and regulations on the
Yeah,
refineries, and so some of the refiners are saying we just don't want to operate in California anymore. It's just you
believe me.
guys have your own proprietary blends of gasoline. You regulate the hell out of us. It's just we don't want to do it anymore.
Yeah,
And at least one refinery is slated to come offline. And the issue that we have is that um, we're not going to have enough refinery. We're not going to have enough refining capacity to make California grades of gasoline.
yeah,
And so, and that's really a big part of this is that you have a proprietary blend. So there's a couple things that the state can do. Reducing taxes isn't going to help if you have a proprietary blend and there's insufficient amounts of it.
right.
What they can do, and what they probably should do, is suspend these requirements so that we basically can use the same gasoline that everybody else has,
Right.
um, at least for the time being. I mean, it's always the way. I think it's a death by a thousand cuts, but there can be certain tipping points that create real hardship, and I think that oftentimes politicians think, well, we're going to make this change, we're going to make that change, and each of these changes, maybe they wouldn't be existential in their own right, but they have a cumulative effect over time.
Yeah,
And if that cumulative effect is that you do something where all of a sudden it creates a step function in supply. And what is a step function? A step function is when it doesn't, it's not some sort of gradual curve, but where somebody material operates a 150 barrel a day refinery and says, you know what, I'm not doing it anymore. Well, that's now material. 150 barrels is 42 gallons a barrel. That's a lot. You can't, we can't really absorb that very easily.
yeah,
And so I know that there are conversations going on about, maybe there's a little bit of backpedaling and, how do we keep these guys here? The people who actually make stuff that we need, you can beat them like a red-headed stepchild, as they say, for only so long before they say no mas.
yeah.
So my hope is that some. Yeah, so seven-figure mission says, I think there's a catch-up trade for copper and have been seeing some outflows from Bitcoin into gold. Seasonality, maybe.
Yeah.
Well, what's interesting, and we were talking about this. Here, I'm going to pull up a chart of Bitcoin because it actually rebounded today. So this, I think, is kind of interesting. I'm going to put gold in here as well. So we can see that these two.
Share your screen, Mike.
Something wrong with my share.
I
Okay,
stopped.
let me hang on.
Share
Hang
on
on. This is probably no, it's not you. It's almost certainly me. How about now? What do we got?
There it is.
Yeah.
We
Okay.
got a bloom.
So I'll just put a 1 month chart in here. so we can sort of see or actually maybe a little longer than that would be better. But yeah, you can sort of see what's been going on here. These things kind of tracked together for a little while, and then recently they broke. And, maybe it's funny that we look at this now, because maybe that could have been a warning sign, that there was some relationship, some positive correlation, seemingly up until the 10th day of October. And then all of a sudden, this pretty big divergence here. And, we're seeing that divergence, which occurred right here, this was dropping and gold was rising, that seems to have corrected a bit today, which I think is rather interesting.
Yeah, folks are wondering with Bitcoin, is the 4-year cycle peaking here now? There's traditionally been a 4-year cycle because the halvening happens every 4 years, and that also tended to occur at the same time where we have a liquidity cycle. And the liquidity kind of cycle was finishing up at the same time when the 4-year cycle in Bitcoin was coming to an end. And so there's been all this online argument about whether or not there's still a 4-year cycle, because the run-up in Bitcoin has been rather muted compared to previous 4-year cycles.
What do you think about Freeport here as a play on copper?
Yeah,
I mean, it's essentially unched for the last several years, so it's not like you're really caught chasing it. They do have some exposure to precious metals, not so much. I mean, it's not a huge portion of their
it's a byproduct
mining activity,
of mining copper. So they get some silver, gold, molybdenum, and they've got, I guess, some mining operations in the U.S. now. So typically I like it because they're a low-cost producer. I did see that they had a force majeure about 2 or 3 weeks ago, and I don't know if that's still in place. And what happened is there was an accident at the mine, and a couple of people passed away. So they shut down mine operations. And I don't know if that's still going on or not. Bad thing. We don't like to see that happen. And whatever happened, hope doesn't happen again.
That did create maybe an opportunity in the following sense. We got a big pop in implied vol.
Yeah.
So maybe a buy right?
Perhaps
in Freeport to take advantage of something like that.
Yeah.
I'll just pull up Freeport here in the options play app real quick, and we'll modify a long stock position here. Add a short call to this. We can go out maybe 60 days or so. Stocks. We'll pick
45, 46, something like that.
Yeah, I mean, you end up with something that looks.
Give it a little room to run, yeah.
Yeah, I mean, this gives you about 10%, a little more actually, to the upside. If you're selling the 46s, right? So you get a little more than 10% upside in terms of capital appreciation. Plus, you collect. What did I see? $1.19 was that the price that I was looking at there? $1.20 ish. Let's call it $1.20 over $41. So we're going to put 41.5, so that's 2.9-ish%.
Yeah.
Over the course of just under 2 months. And then just look to roll it. I don't know if we have, sometimes when implied vol gets really high and you get something that chops around like this, I rather like, believe it or not, going fairly long dated, but I don't know how high that is. So, for example, Strategy had a very attractive buy rate beginning of this year, simply because the long dated, the 1 year implied volatility was madness.
Yeah.
It was just so high that you could get a huge amount of premium for selling a 20% out of the money call on it. Here, it's not quite like that. It's mostly this short dated piece there's a lot of. Let's take a look.
That's probably, there's probably still some issues. I don't know if we can find out.
They report the day after tomorrow. But this doesn't typically move that much.
No.
So, and I don't think that's, these things are propelled, something like this, these commodity plays, they're going to be propelled primarily by, sort of the broader macro factors their operating and input costs and the price of the commodities they sell. And people know that, right? Yeah. So you're able to model it out. Like your spreadsheet's going to say, well, they mine about this much and they have this much in reserves and here's the current price, and you just multiply it all out.
Yeah.
I wonder if you could actually go shorter dated here and still collect a decent amount of premium. What would be? You go to the 45s, you can collect 90 cents actually for the 45s. These expire in a month. Yeah, that's not bad either, actually.
Yeah, that's not a nice trade. That's a nice trade-off.
Yeah.
There's another name, Mike. If there's still operating issues at Freeport, and that is Southern Copper. Their ticker is SCCO. I wondered what their vol surface or vol term structure looked like, because
well, let's take a look.
Because if it's gonna you forgot the equity go.
There we are. Let's see.
Oh, it's still a little bit inverted. No, wait a minute. Mm-hmm. Not much.
I'm going to get rid of the red one, just so this is what we're looking at.
And it's not nearly as inverted.
Yeah, let's just take a look what's on their event schedule. So I assume they've got earnings coming up on tomorrow. So they're SCCO. That, by the way, can give you some read through for those. This is a common thing. Industries and sectors will tend to report together for the most part. So all the banks are reporting around the same time, and then you get a week when you get a lot of big tech companies are all reporting around the same time, and so it's not surprising to see that these two are reporting a day apart. So this one's going to report first. Let's see, it's implying a move of about less than 5%, but its average move is nothing. So again, this kind of goes to what we were just talking about. So I wouldn't be that concerned about selling some premium in this one either. Going into the print, and let's take a look at how that one looks. If you're interested in a potential buy right on this one, modify that. And here too. Now this one only has regulars, so you just go to the no regular options and try to give yourself a little bit of upside. So probably up to the 140s here. Yeah. That's not bad. You're going to also once again collecting close to 2% or more of the current stock price, and still giving yourself $10 or so worth of upside, almost 10%. In total when you calculate the premium you're also collecting. And given the relatively modest moves that it has historically demonstrated around earnings, and that was an 11-year history we were just looking at. And the average post-earnings move is about 2%.
Can you flip back to Bloomberg on that and look at the events? Because they'll probably have a dividend coming out pretty soon.
Yeah, let's take a look. So their projected dividend, which they're also going to declare when they report earnings, is 80 cents.
So it goes. It looks like. Yeah, so you'll collect another 80 cents on that 1-month option.
Yeah. Well, that's right. So important for people to remember. So they're expected to declare the dividend tomorrow when they report earnings. And they go X on the 5th, so that is prior to the expiration of the option. And so the stock can be expected to go down by the amount of the dividend amount on the ex-dividend date, which in this case is going to be about 70 basis points. So, going back to our other screen here, we can just do a little bit of calculations and say, okay, so on this, I lost the other piece of this, but that's a very good point, and it's something to remember that if you're looking at something like this, you're going to say, okay, well, I'm going to sell this call, collecting almost $3, but the stock is going to go down, all else equal, by approximately the amount. Well, not approximately. It's going to go down by the amount of the dividend,
Yeah.
The net present value of the dividend, which is effectively the dividend, because the distance between the ex-dividend date and the pay date is typically very short. So, effectively in this buy right, you're not really getting 290, 295. You're really getting something more like 360, effectively. It's the way to think about it. You're going to, in terms of what you're going to collect, you're going to have a dividend payment for call it 80 cents or whatever, and this is the mid-market price, so maybe you end up having to sell it at 290 or something like that. But it gives us a sense of where you're at. So I think that's a decent trade as well.
Yeah. What do you think about the poor man's gold, silver? Because gold is making all-time highs, and silver is basically running up against this $50, $52 area, which it seems to go back to 1980. It can't get above that level.
So it is interesting. Well, silver, unsurprisingly, also got really hard hit. But just so people can get a sense of it, this is the gold-silver cross right here. Way to think about it is, and as you can see, that the relationship in terms of gold prices to silver prices, it's right up there, right? So one of the things I would point out is that when we had the prior real bull market in gold, don't forget that there was also the Hunt brothers were trying to squeeze the silver market around the same time.
Yeah.
So we had two situations where precious metals were highly elevated. So that's one of the reasons why that cross, meaning the relationship between gold and silver in that period, because silver hit $50 an ounce back then. So and that makes sense, right? So gold was 800 at its peak, silver hit $50 an ounce also, so you're getting to about 40x, and that's about where it was. Now it's about 80x, or a little bit higher. And to me, my thinking is that, I felt like silver had room to catch up. I kind of like copper for their catch up as well, though, because of the industrial reasons that we just highlighted.
Yeah.
But I don't mind this one as well. And also platinum. Where's platinum right now?
Just to remind people, when we were on the gold standard, the ratio was fixed at about 15 or 16 ounces of silver per ounce of gold.
Mm-hmm.
And so people always thought, well, it's going to be bouncing between 15 and 20. And it really caught people flat-footed when it got up there to 80, 85, as you just saw. Where silver just really became demonetized and really only became, got its value from its industrial uses, which is used a lot in electronics, and it's used in solar panels. And I've always been a little surprised, given the massive production of solar panels, that silver didn't do better. Because those little lines on the silicon wafers are a silver alloy, and so
platinum also getting tagged today,
yeah,
as you can see.
Yeah.
So I do think it's a little bit interesting that we've got Bitcoin higher and all the metals so sharply lower today. They had that divergence, which is now a couple weeks old, but that is rather
well, notice with platinum, it hit its peak back there in 2007-ish, 2008. Hasn't been able to get back to that level, whereas again, gold is, massively higher than its 2008 level. Now, there was a reason people were starting to ignore platinum, because they were saying, hey, if we're moving over to electric cars, we're not going to use platinum and palladium for our catalytic converters in our cars. Demand's going to go down. And then just when you thought that was going to be true forever. Here it goes. It rips from 1,000 to 1,600.
Yeah, the interesting thing there is that I think that, well, there's a couple things that are at work. One of them is the, the fact that they're getting rid of the federal tax credits for EV purchases.
Yeah.
There was a big uptick in EV sales right before those credits expired. And, I think we've heard a lot of people say, oh, Toyota's on the right track here because Toyota was focusing principally on hybrids. And, that there was a sense that the bloom was a little off the rose with EVs.
Yeah.
Now, what is interesting to me on this is that I wonder sometimes whether in the United States we have the best read on this. And I will draw people's attention. I'm sure that there are a lot more people who have seen this podcast, but if you haven't, I encourage you to look at it. It's one of the more recent Joe Rogan podcasts. He had Palmer Luckey on. Palmer Luckey.
Oh,
yeah, so Palmer Luckey, for those who don't know, but I'm sure everybody who's watching does, he's the founder of Anduril, which is the defense contractor technology. He's a Silicon Valley guy. He's the guy that created Oculus, which ultimately got sold to Facebook. He was a VR guy when he was a teenager, actually. Started working on it when he was 14. Started developing stuff by the time he was 15 or 16. Sold his company, when he's like 33 or 34 years old. Yeah, but one of the things that he was referring to, which I thought was interesting, so as we think about this, and we're saying, a lot of people in the States were saying, oh, well, the EV trade is overdone. He actually talked about his experience going to China. And he was pointing out that the Chinese are building fantastic cars, apparently, in his view. Their electric vehicles in particular. And they cost a fraction of what cars in the United States cost. And it is clearly a much bigger market than the United States is. So while I do think that hockey stick that we saw for EVs in the United States, that has probably slowed for the time being, I don't think that means that the EV trade is somehow broken. My guess is that there's too many things in favor of them. They are, they're much simpler, and in terms of the user experience. I mean, we're on our second EV at this point. These things, they never go in. They don't require maintenance. They don't. You plug the thing in and that's it. There's no oil changes. You change the cabin air filter.
Yeah.
That's about it. But if we saw our market open up just a little bit to things like Chinese cars, people will say, oh, well, in the United States, we do have a lot of imported cars. We have a lot of Japanese cars. Yeah, well, the Japanese cars are all made in the United States. Like Camrys are made here. Accords are made here. Toyota Tundras are made here. In fact, in some cases, those cars actually are more U.S. than some U.S. cars are, where the body panels are made in Canada or Mexico or some other place. So I think I wouldn't get overly enthusiastic about going towards hybrids just yet. I know that Guy Adami, for example, he had Toyota Motors was one of his picks for the year. We'll just pull that in, and it was a great. I think it was. Let's see, go like this. I think it was a pretty good trade. Yeah, sure. So 170, it's up to 202. So nice return on the year. Over the last 52 weeks, but I think that we shouldn't get too enthusiastic about that. I do think that we're ultimately going to have more EVs, and I will I'll say something that one person had made a comment to me, and they're like, "Well, what about the risk of fires on EVs?" I said, "The risk of fires." And they're like, "Yeah, these batteries, the batteries overheat or they get pierced, and a fire starts, and of course, and there have been a couple really tragic instances. Right? There was an instance locally where some kids in a Cybertruck in Piedmont, California, crashed and the thing caught fire. And there have been a couple other stories like this. But the way I respond to those people is the minute that you start using a gasoline-powered mobile phone, then I'm ready to listen to you. Nobody's going to do that. No one's going to put gas into a phone and say, okay, yeah, we're going to go like this, and feel like that's a safer solution than having a lithium-ion battery in the phone. I mean, that's just ridiculous. There are risks, of course, but there are risks with gasoline and diesel vehicles as far as that goes as well. I just think that, we're in the United States, at least, it's a temporary pause. That pause is incentive-based. $7,500 tax credit is a powerful motivating force. Actually, the first Tesla we got, we didn't get a tax credit because there was a cap on how many cars the company could sell. And, when Holly got hers, it was past that cap, so there was no tax credit for us. I think we got one on the second one because they reintroduced them. But I also think that people are probably less concerned about Elon's political view since he's sort of stepped away from D.C. a little bit. So in places like where I live and where you live, that are typically very blue states, I haven't seen as many stickers that say, I bought this car before I knew Elon was crazy and things like that, which I think is a bit unfair. But it does influence people's behavior. So, yeah, I would probably. Actually, that brings up another thing. What do you think about rare earths? Which company just made an announcement yesterday? Rare earths.
It's Something Pass. Was it Something Pass? Forget the name.
Just yesterday, I kind of felt like, all right. Oh, it was Cleveland Cliffs Steel Company. That's right. And I kind of felt like, all righty, this is like adding .com to your name. Back in late 90s, early aughts, it's like adding AI to your thing nowadays. Like, a mature industrial is now we're in rare earths. Well, that I didn't really buy that. Well, it looks like the market didn't really buy it either. Look at this. That thing, it gave everything back from that news.
I bet that was a bot. A bot probably read it and made some trades, and then people monitoring the bot said, "Nah, no," and reversed the trade shortly thereafter.
Yeah, this one I found it also very interesting because this is a business that's really foundering. This maybe you can opine on this. I was looking at S&P equal weight versus S&P 500, the conventional cap-weighted index. And it has been underperforming quite considerably. So we can look at that this way. We can take the equal weight ETF, RSP, and compare it to SPY. And we can see, and throughout history, there have been periods when equal weight outperformed, and there have been periods when cap weight outperformed. So here we're going to look at a 20-year history, and we get some sense of this. What I found interesting was how choppy the earnings for the equal weight index were. Much choppier than, at least when I did a preliminary look at this. And I was thinking about that. I was like, well, why is that the case? And I think it's the Cleveland Cliffs of the world. That you end up in these situations where old world companies that were very capital intensive carry a lot of debt. That competes with fast growing high margin businesses. And because of the cap weighting, the cream rises to the top. And typically speaking, within the last 25 years or so, the cream in the S&P has certainly been generally high growth, high margin, lower capital investment, less debt for those companies. And maybe the exception in all of this on a cap-weighted basis would have been financials during the GFC. And that just took everything down. But what are your thoughts on this? Do you think we might be looking at a situation? Because you can see this is that outperformance that the S&P has had relative to equal weight since 2022. Let's just put this in as a daily. That's on a quarterly basis. So let's go to 12/31/2021 and see if I can get a daily in here. And yeah, so is that right? Oh, no, right? 12/31/2021. So that's the outperformance. What is this date? That's actually 2023. Big outperformance, 01/12. I mean that's huge outperformance. What do you think?
Well,
should we be thinking about pivoting back into?
Yeah, I don't see any reason why there's not going to be some mean reversion there. And the big caps run ahead of everything else, and then they'll lag while the rest of the world catches up. That seems like a reasonable strategy, especially when you looked at that's the way it behaved if you look back over super long periods of time.
The other thing I was thinking about was Berkshire Hathaway. Something like 47-48% cash here. So if you're struggling to identify sort of old world value businesses to good quality businesses to purchase, you could buy Berkshire and wait for those guys to do it. Yeah, look at this. $500 billion in net cash.
Nice.
$500 billion in net cash on Berkshire's balance sheet right now.
Yeah. Now, pull up a quick chart on that one, because the stock did sell off after Warren
49% cash.
announced that he was going to retire. His present age to stay on as chairman. So the stock came off from 540, and fell to 460. Maybe that's as far as it was going to go, and it's going to continue marching back up. So the Buffett premium was, I guess, about 15% of the market cap.
Here's another interesting thing. So it doesn't seem compelling. I recognize that people are going to look at this and say, I don't want to sell puts in Berkshire Hathaway because they don't bring you anything. And I can understand that sentiment because it certainly looks that way. It's only 15% implied vol going out 3 months. So that just looks like a big nothing burger. But let me just offer the following. Cash isn't that volatile. 49 cents of every dollar that you have in this stock is in cash. Which, by the way, also gives you a sense of, they're making substantial interest income. I mean, if we figure that they're getting, 4%? Just to keep the math easy.
Yeah.
That's $20 billion in interest income alone that Berkshire should be making. I think that's kind of intriguing.
Kind of remarkable.
Yeah. So I realize that, selling options against Berkshire, maybe selling some strangles against it, buying some stock and selling strangles where you could scale into more stock. I really think that the downside risk is de minimis because
I agree.
We just saw what those lows were. 460. 460, so that's down 30. Again, at that level, at those lows, and the company's generating some free cash all the time, at those lows it's 50 cents. $230 a share in cash or thereabouts, probably. So I think that's kind of an interesting one as well. Let's see if we have any other questions here.
Yeah.
I don't see any. People are nursing their wounds in the gold trade, perhaps. But yeah, I think that's kind of where we can leave things. I rather like, I realize it's not that exciting. I I think there's a lot of value in the investment approach that those guys take. And they've got a lot of cash to deploy. And if you look at this business on an ex cash basis, and this is the other interesting thing, you invest in a private equity outfit or something like that, or a SPAC, you're basically paying them. No, that was not a disconnection. That was Mark's camera froze. Oh yeah, look at that. He froze. Well, he was having some technical difficulties before, so I'm guessing he's out of it. I want to just leave people with this. I think Berkshire is interesting here just because they are well positioned to take advantage of opportunities on any kinds of pullbacks. They're in a good spot for that. When you look at the value of this business, think about their earnings. Hey, Mark, you're back. I was going to say, as you look at Berkshire, look at the business on an ex-cash basis as well. And if you're thinking about it on an ex-cash basis, so their adjusted anticipated net income, 44, that's really, that's quite remarkable, right? So so the enterprise value is about $543 billion. And the company is projected to do $44.6 billion in net income this year. So it's trading 12 times EPS ex cash.
Yep.
And on the cash, well, part of that, in a way, that's not really fair. Why is that not fair? Because $20 billion of the net income is coming from the interest on the cash.
Right.
But I guess my point is that you're getting paid essentially the risk-free rate to allow that team to sit there like an eel in a cave waiting for something tasty to swim in. And I think that's what they're doing. So I think a buy right in the copper trade, Freeport, we liked that one, right?
Yep.
Southern Copper, we liked that one.
Yep.
Berkshire Hathaway, we like that one.
I agree.
Gold, be patient.
Be patient.
There's a lot of, not saying it's not going to catch a bid here, but there's a lot of air under there. It's not, if you reach out and try to catch the falling knife right now and it continues, there's a lot of room for it to go lower before it hits meaningful support, which we figure around 33-ish, 3,400-ish an ounce, something like that, the 200-day.
I think.
Yeah. So, that's office hours for today. We really appreciate you guys tuning in. Like, subscribe, put your questions and comments in there, and tune in this time next week for another edition of Office Hours with the Professor and Professor Mark Guthner. Thank you very much for your time. Enjoy the week.
Thank you. Good to see you, Mike. Have a great.
See you later.